Welcome into NFM TV. I'm your host, Greg Scher. We are joined right now by former president of the NBA, David Stevens, also former FHA commissioner, and currently the CEO of Mountain Lake Consulting. David, glad to have you with us again. Can you catch us up to speed? Is there any relief in sight for the servicers at this time?
Well, as we all know early this morning, probably waking up and watching the news, that a $2 trillion agreement in principle had been made between the Democrats and the Republicans. But the text of that bill actually has not been written yet. It's being worked on right now. So it tells you how real time this all is. In that package, there's over $500 billion in specific relief to our industry. And that's outside of whatever payments are made to Americans and unemployment benefits and things of that sort. The package does include a significant amount of money for liquidity. It'll be using through the Fed window, opening that up to both bank and non-bank to be able to get liquidity to finance their servicing, particularly their advances. I've spoken to senior executives at the GSEs as recently as a couple hours ago. They're working feverishly to come up with a liquidity facility for their customers at Fannie and Freddie. We should hear more about that. I told them we need to hear about it today, but let's open the next 24 hours. There's an FAQ that the GSEs are going to put out, which you should hopefully see later today or tomorrow, answering a lot of questions about forbearance and what does that mean. There's a ton of questions, Greg, that we can't cover in the amount of time here, but it includes everything like, okay, I closed a loan. The borrower's already notified me that they can't even make their first payment, and I hadn't sold that loan to Freddie or Fannie yet. Is it saleable? And I will tell you the rules are under forbearance that a loan in forbearance is in default. You can't sell a loan in default to the GSEs, and so technically that can't be allowed. So the question is, can there be enough pressure put on the GSEs to open up their balance sheets and actually hold those loans? And then see what happens on the performance side down the road as we come out of the virus. As I emphasized to a top executive at one of the GSEs this morning in a call, these are unprecedented times and we can't just follow the old rules. Servicers, as you know, are scared. I mean, their phones are ringing. They have borrowers notifying them that they may not be able to pay their mortgages. They're reading about forbearance plans where, especially in the Ginnie program, they're going to have to make advances to the MBS holders, and they clearly don't have that kind of liquidity. And by the way, the system was never built for an event like this. So that, the last thing I think any of us need to hear is, oh, that shows weaknesses in non-banks and that kind of thing. The system wasn't meant for a world where we were going to allow the entire nation to go into forbearance. This is just the most unprecedented period of time, and these companies are working extraordinarily hard to survive. And it's affecting different companies differently. I'm not going to mention them by name, but in the last, if you're watching the news, you're reading about some that might be in bigger trouble than others. I think particularly, non-banks with big servicing portfolios, especially if it's a big Ginnie servicing portfolio. That's where you really may find yourself in a shortfall in terms of liquidity. We're having issues on the multifamily side as well for multifamily lenders that deal in dust bonds from Fannie Mae and K deals from Freddie, but primarily dust bonds. And Fannie stepped in and bought some dust bonds yesterday. But I will tell you that, all of this is happening in real time. And I would just, I would caution that while we're overwhelmed with nervous energy and news that could sink, in its worst case, a lot of companies, we also know that this legislation was just passed. We heard about it again on the morning news. It's not even written yet. The team is writing it. The team that's writing a lot of the language we care about is in the Senate Banking Committee, and they have staff on that committee. Some who used to work at the NBA when I was there, and they get it. They understand it. So the question is, what's going to be made available? There's a new Fed announcement about using the TALF facility for securitized MSRs. That could help a couple of larger agency, primarily non-bank servicers, especially if they've already securitized some of their MSRs. But Greg, we have co-issue is gone. We have no bids on MSRs. Generally, we definitely have no bids on Ginnies. I was told today bids could go negative. Negative is like a no bid. So we are going to go through a period here where liquidity is going to continue to be challenged. I think for anybody who has a current pipeline, hasn't forward traded in a TBA or committed through a cash window or to an investor, what I'm hearing is that if it's agency or Ginnie, most investors are honoring the obligations that they agreed to. But in terms of new business and looking past your existing pipelines, that's where the questions rise. Clearly, non-agency, meaning jumbos, non-QM, I would just assume that market's gone and I wouldn't even play there if I was a lender right now. And thinking about long-term getting servicing bids on my business, I believe for right now, given the uncertainty, that's going to be far more challenging. I talked about the need for the Fed to step in. They did step in. They bought. They've now picked up their purchasing. Somewhere in the $70-ish billion per day, and we saw 30 years come back in by close to 200 basis points by yesterday afternoon. Now, mortgage rates didn't do the same for a lot of other reasons having to do with servicing values and investor concerns. But mortgages did come back. So, these interventions can have fairly quick impact, but it's happening in real time, and we're in a true crisis mode for our industry as it relates to the business.
Well, from the perspective of loan officers and salespeople who are seeing their companies tighten up, put overlays in, eliminate some products, what do you say to them?
Hang in there. If you're a loan officer and you've been doing this for the last 6 months, you're just ending some of the best months you've ever had in your career in terms of new pipeline. I'm not sure what your pull-through rates will be on some of those mortgages. And if I was running a mortgage company today, I might be tightening up my pre-close verbal VOE. I know most companies have a 10-day pre-close verbal VOE. I'm encouraging my clients to maybe do something closer to 24 to 36 hours before to make sure that borrower is going to be employed, particularly in harder hit sectors where their future employment may be at risk. These aren't things people want to hear. LOs are worried about their long term. I will just say, rates are going to come back. I think this package is going to do a lot to bring relief into the markets. I don't think we're going to get unstuck from the Ginnie Mae problem, the non-QM problem, or the jumbo problem anytime soon. And for correspondent lenders that we're also doing co-issue transactions, I think a lot of that stuff's going to be much more difficult. But there's product available. Freddie Fannie is going to be the most liquid as we move through this. The only problem with Ginnies, as everybody knows in the business, is in a forbearance plan, the requirement to send scheduled P&I to the investor, regardless of what actually was paid to you, especially if it's extended forbearance periods, would be an outrageous financial implication to the entire mortgage system. And we still don't know yet the details of what the forbearance plans are going to look like. Does everybody get it? Do you have to show hardship? I mean, these are questions that we dealt with head on when I walked into this last recession in the previous administration. I think this is all in a much tighter time capsule, all happening quicker. And I think, frankly, they aren't necessarily as well staffed to deal with this. It was unexpected. And so, all I will just say on the good front, I'm glad to see what the Fed's been doing. I'm glad to see the legislation pass, even though the deficit impacts down the road scare the hell out of me. And I think for our industry, the cavalry's coming in. It's just a matter, will it cover the entire industry? It can't. And that's where you just focus on getting your pipeline done. Your realtors are scared. Your home builders are scared. I'm encouraging lenders to do training and video calls with their clients, bringing experts in. I'm doing I'm doing 4 in the next week for different people around the country to just talk to the industry. Because in the end of the day, Greg, I'm going to keep going back when this is over, and maybe by Easter, maybe a lot longer than that. But whenever it's over, we have a huge demographic of people who need places to live, and that demand's going to come back. And so how we deal with it right now is going to be critical. How we deal with this virus is going to be critical. And then how we deal with the housing components, which is, again, addressed in the legislation, the Fed, FHFA, along with the GSEs, and HUD with Ginnie. I mean, these are all sectors of work product that are going on. I'll give you one little, sort of interesting one. So NMLS requires for new loan officers to get fingerprints. Well, how do you do fingerprints if you're working remote? And if you've been hired, can you start with a company if I can't get fresh fingerprints? I mean, so we have groups. I know the MBA is doing this, but others there's work products that go down every work stream here of issues that need to be addressed. And there's a whole army of people working on them. And again, we're going to get a lot of solutions, but we're not going to cover, this isn't going back to where we were 3 weeks ago. So not for a while in any case.
So your best guess, do you think that the servicers are going to be made whole? Do you think there's going to be something set up where this thing can run and servicers can be made whole on those forbearance payments? And if so, when? I mean, just your best guess. I'm not going to hold you to it, obviously, as you don't control all these
My
things.
guess is, my short answer won't be the one you want to hear. I don't think they'll be made whole. I think there's going to have to be some form of haircut applied to the servicers who get liquidity. And it all depends on what shelf they use, whether it's the TALF shelf, whatever the GSEs create for their customers. If Ginny can create an advanced platform where they can make advances on behalf of their servicers, then it's going to come down to how long can they do it for? Is there going to be a haircut that the servicers have to pay a portion of that, or they'll get reimbursed for a percentage of that remittance that has to take place? And then will there be fees associated with that? And I can tell you from what I've seen, it really depends on which solution you're using. In some cases, I've seen haircuts that wouldn't be able to be covered by the industry, by all of the industry, but I also see some that some particular large non-bank players are more than willing to pay the haircut in order to get their servicing in a securitized asset and then getting capital relief. But the ratings agencies are engaged here because to get capital relief off a TALF shelf on your servicing, you first have to get it securitized. You got to hire an investment banker. That's going to be expensive, and then you'll get liquidity back based on the rating of the tranches of your securitized MSRs. So there'll be some tranche that's AAA, but it won't be the entire strip. And so, their liquidity impairment is going to be difficult. So in the end of the day, I would just say, look, we have a lot more coming at us in terms of solutions than we had 48 hours ago. That's the good news. But the same calls you're all getting, and Greg, that you're hearing from originators, I'm talking to CEOs across the space in the industry, and everybody's trying to figure out what the options are. And there's a lot of work going on the Hill right now to try to get influence in terms of how that legislative text gets written on this bill, because that's going to have a lot to do with how the forbearance process works and how potential remediations can come into play.
Well, I hear your phone ringing. We'll let you go grab that. As always, David Stevens, we really appreciate your time and you and all the people in your group. I know there's a small army, as you've told me multiple times, fighting for the independent mortgage banker. So the whole community thanks you for everything, and we'll talk to you real soon.
Sounds great, Greg. Thank you.
All right. Take care.